Welcome back to Nasdaq Live. Joining us today is Ketul Sukhpara, Associate Portfolio Manager at the hedge fund EQC Funds. Thank you so much for being here, Ketul.
Thanks for having me on the show, Vinita.
Sure. So what is your take on the markets?
To put it in one sentence, I think the probability weighted downside to the markets is a lot higher than the probability weighted upside. And why do I say that? As you know, the risk that we have seen from Europe, Asia is flirting with recession. Europe is probably already in a recession. And US, the numbers are not so good. They're improving, but the macroeconomic reports that we have seen, they're not that good. So that's one side of the story. That's the risk part. From a valuation perspective, if you consider the S&P 500, it's trading somewhere between 11.8 to 12.1 times earnings, based on whose estimates you believe in. Historically speaking, that's the lower end of the valuation. But valuations or a price to earnings multiple is typically based on the expected growth. In the US, I think the rosiest forecast that I've seen for GDP growth is around 3%. That's the best case scenario. If everything falls in line the way we want it to be. But about 50% of the S&P earnings is not from US. It comes majority from Asia and Europe. And these two, as we know, they are the shaky legs right now. So if you consider that, the growth scenario is not quite robust. In that case, the historical average multiples that we have seen for the S&P 15 might not be very correct multiple. So even though from a historical perspective the valuation looks good, but if you consider the recent developments in the world, that valuation might not be too cheap.
Right, and when do you think the markets will sort of smooth out?
I think smoothing out, we did a test of correlations for the S&P 500, and in the last 6 months to 1 year, the correlation to the euro is about 0.8, 80%. So 80% of the time, the S&P, the US markets, move up and down based on what happens in Europe. So as you can imagine, in the near term, markets can only smooth out once we have a permanent long-term stable solution to Europe. As of now, the probability of that happening is very low. We just had 3 new governments in the countries that we are most concerned about. That governments will take time to settle in, so we don't expect them to smooth out anytime soon, at least not for the next 2-3 months.
Right, and just so our viewers know, what are those 3 countries that you're speaking about?
Italy, Greece, and Spain.
Okay, so we'll get to Europe in a bit, but I just want to know, what is the mood among investors right now amid the global market volatility?
I think the mood is risk off right now. We don't want to take a risk. To give you a very good analogy, I feel like this is the climax of an action movie. There's a lot of gunfight going on, there's a lot of explosions going on, a lot of high-pitched drama, and I would rather sit on the sidelines, be in the audience and watch it, rather than invest and be a part of that gunfight. So that's the mood. On the other end, when that gunfight gets to an end, and when you see, and then they lived happily ever after, you don't want to miss that part too.
Right.
So I would say the mood is pessimistic, but I would layer in my investment slowly as we see a definite conclusion coming to the European crisis.
Right, and what's contributing to that pessimism? Are investors concerned of a breakup of the Eurozone?
Absolutely, that's a big risk, and I think that's one of the biggest risks out there. A breakup in the Eurozone brings a host of unthinkable outcomes into the list of outcomes that we have. Just to give you a very simple scenario, the Italian debt market, it's about 2 trillion. If Italy asks bondholders to take a 10% haircut, it's a very small haircut given the other haircuts that we have seen so far. That's 200 billion. That's the entire financial industry in the Europe. That's every bank included, wiped out, period. So this is just one scary scenario, and if the euro breakdown is chaotic, and to a certain extent it has to be chaotic, otherwise it won't be a breakdown. There are 10 such scenarios which you could come up with, which are very scary, and that is what I think would keep most of the investors up at night.
Right, and what can investors do now here in the U.S. to prepare for that possible breakup of the Eurozone?
Obviously, one is if you think that is a high probability outcome, you would want to be in cash. There's nothing that's better than cash. Then there is some part of a portfolio which you want to have certain risk added. I think on that side you could add stocks which have a certain amount of certainty in terms of earnings, dividends. I would go with high dividend paying utilities. We also invest in master limited partnerships. Those are the high dividend paying, stable, monopolistic type of companies which are better shielded from the outcomes of Europe compared to some of the other sectors in the industry.
Mm-hmm. And what else can investors do to manage risk against the markets tanking?
Risk management right now, it has become almost like there are two specific sides of your portfolio. One is the long side, the other is the short side. At EQC, we pay equal attention to both. Especially in the last 2 years, I think managing the short side has become very important. And just like you would go for valuation on the long side, you want to go for valuation on the short side. To give you an example, if you go and buy protection for downside protection on your short side, you will not get a good deal if you are going when the VIX is at 40. That's expensive protection to buy. So what we say is we like to buy protection when the VIX, the volatility index, is at 20.
Yes, thank you so much for that great advice, Ketul, and we hope to see you again on Nasdaq Live soon.
Thanks, Vinita.
Thank you. Back to you, Shivani.